I'm sorry, Amanda, did you say something? Or did somebody
Can you
say
hear
something
me
in
okay,
line?
Professor? Can you hear me?
Oh, can't really hear you. Turned up my computer sound. I don't know if there's a separate control for Zoom. Oh,
Well, can you hear me? No.
all right, let's do this. Okay, could you please ask again, Amanda?
Can you hear me, Professor?
Good, there we go. Okay.
There we go. I thought that was weird because I was saying hi and you didn't hear me. So for the My Accounting Lab, I was able to get access, but it's not syncing the grades to your Canvas. So I just wanted to let you know that.
Oh, thank you. Yes, in fact, you're in one of the two smaller groups on Canvas that I have. So this class, like I said, is actually divided into three different Canvas groups or classes. So you're in a group with 2 students, and then I have another group with 3 students on Canvas. And then I have 27 other students.
Oh,
So
goodness.
that's how Florida Southern tends to break things down. Day students, adult students, and then I don't know what the other classification is. So, yeah, it appears that there, well, I know at least managerial accounting, there is a problem with syncing. So now it's appearing that that is happening in here too, although not as severe.
Mhm.
Um,
And I did get your email, so I did receive that.
Oh, good. Nobody here in the live section did. So you're one of the lucky ones, I guess.
Yeah. Yeah, I got that email and I was able to register through Canvas for the Pearson, but for some reason it won't sync it. So I'll call them. I'll call their technical support and see if they can help me with that.
Okay. And I'll go back into my accounting lab as well and see if I can do anything to get it to sync. But I bet it's
Okay.
going to be a Pearson technical issue.
Yeah, it does.
No,
Thank you, Professor.
no problem, Amanda. Yeah. By the way, how is textbook customer service anyway, publisher's customer service for things like Wiley Plus or my accounting lab? Anybody had to contact tech score? Okay. Well, I should say that in the publishing industry, there's been a lot of consolidation. So big publishers have bought smaller publishers. They become even bigger, just like banks have consolidated. And whenever you have consolidation, what happens to prices? They go up. And what happens to customer service? Goes down. I'm afraid that's what's happening with Pearson right now in my accounting lab. And they're not dealing with it. So don't worry, we'll get it solved. We'll figure something out. Oh, and what I did say in the email that I tried to send to you, that I'm extending out all assignment dates. So through chapter 9, I will extend all my accounting lab due dates until I think it's February 15th. Let me double check the date of the first exam. Yeah, February 15th. By the way, the exam will be on all those chapters, probably through chapter 7, chapter 8, someplace through there will be the cutoff. But I will go ahead and extend everything to February 15th. So don't worry about that. That's more than sufficient for you. But just want to make sure that everybody is taken care of. And so we'll work around things. Okay. So I will be sending another test email by tomorrow. So if you don't get an email from by tomorrow night, let me know, and I'll see if I'll try to have technical support here at Florida Southern figure out what's going on there. But it's appearing that there are some issues with Canvas this semester. Is this happening in any other of your classes? Anything? Okay. I know it's happening in applied stats. Anybody have that? Okay. Oh, well, I guess applied stats, that professor and I both drew a bad draw of the cards for this semester. Yikes. You think I should or should not play the lottery? Maybe I would look out in that. Or maybe I wouldn't. Oh, well. Well, as you know, we have a little bit of homework from chapter 1 and chapter 2. How does homework go? Okay, all right. I thought we'd take a look at it. It won't take us very long. So, chapter 1 homework, first of all, starting on page 18. So, with homework in chapter 1, just a couple of different questions, 2 out of the 3 possible types. In fact, well, we had 3 review questions here, and we had 2 sets of multiple choice. Now, what I do with review questions is that I go over automatically if there is a more complicated one. Sometimes there is. And then I open up the floor to requests if there's anything you'd like for me to go over. But most are pretty basic, so we don't really have to go over them together. But with review questions here, let's take a look at number 2. It kind of brings up a good point. So it says in the conduct of audits of financial statements, it would be a serious breach of responsibility if the auditor did not thoroughly understand accounting. However, many competent accountants do not have an understanding of the auditing process. What causes this difference? Well, specifically, they're talking about financial auditing, and I wish they'd said that. But a financial auditor certainly does need to understand financial accounting because that's what you're trying to audit. And if you don't understand what you're trying to audit, well, yeah, you certainly won't even know where to start doing the audit. You'll understand the basis of the financial statements. So, a financial auditor has to understand GAAP. However, we can have a company's financial accountants. They're very good, but they don't understand auditing. That's true. Now, if they don't understand auditing, first of all, does it sound like that financial accountant is a CPA? No. And there are plenty of accountants out there working who are not CPAs. Some people call themselves accountants, and well, that's kind of debatable because they don't have formal training in accounting, little if any. But there are plenty of people who have gone through a bachelor's program in accounting and did not attain the fifth year, did not take the CPA exam, or maybe they attempted the CPA exam and they didn't get through. So we can have a financial accountant not really understanding auditing. Okay, they understand GAAP fine. They can do that job. But that's where it ends. So their career has a limited horizon there. It really does. It's kind of a nice dead-end career, shall we say. So an understanding financial accounting is a subset of the knowledge that all auditors need to have. But a good financial accountant probably earning less than that auditor because they have a more limited scope of knowledge. So that's what's going on there. And over the years, I've had some pretty good students who should have gone through the CPA exam, but they just didn't for whatever reason. And oftentimes I find that, well, they completed the bachelor's, maybe they attempted some fifth year classes, they didn't go for their MAC, and well, they didn't get enough fifth year classes. That's true. Or they stretched things out too far. And if it's been a long time since you had a relevant accounting class, what may have happened to the knowledge in it? Changed. Yeah, certainly authoritative guidance in auditing has had a number of changes. Financial accounting, tax, oh my goodness, laws really changed. Plus, it's just been so long since you studied it, you're rusty too. Now try to sit down and study for the CPA exam, when you're working full time, you have a family, and it's tough. It really is. So I can empathize. And sometimes I've had students with such severe test anxiety that they didn't get through as well. I'm thinking of one right now, he certainly should have gotten through, but he had such test anxiety that he just couldn't. Now, that was disappointing, but I wish he'd done something about his anxiety. And I've had other students pretty much like that too. He's just one that kind of sticks in my mind there. So please don't fall into these traps. So those financial accountants are mentioning here, a lot of those are people who fell into the trap of not getting through the CPA exam. And some people just give up. Okay, I took 2 sections. I didn't pass them. I'm not going to bother with the rest. That happens too. So again, don't do that, please. Well, then, we only had 1 other review, or 2 other review questions, number 1 and number 7. Any questions on those? All right, let's have a look at multiple choice questions here. So they're from old CPA exams, and I usually go over all these because, as I've said before, well, multiple choice will be the number 1 test taking strategy problem that most students face, whether they're multiple choice exams in school or multiple choice questions on the CPA exam. So it really does help that we go over these. So it's not just enough to know the knowledge, but also we have to know how to take the exam. So as we go over these, we'll see common types of questions they ask, common types of patterns why right answers are right, or why wrong answers are wrong. And with multiple choice, well, the instructions say to choose the best answer. Now, does that mean that there's only 1 correct answer? No, you can have 2 or even more correct answers, or at least with some degree of truth in them. But you've got to pick which out of those 4 or 5 is the best answer of them. So we'll see why we can have 2 answers that we can say, okay, we can't say they're incorrect, but Why is one better? We'll see some patterns to why. The CPA exam has its own quirks, but this really does help. Students who take it tell me, yeah, they were so glad that we walked through CPA exam multiple choice questions when they were in school. And I really do try to make sure that I bring up those quirks so that we can see that we can answer them correctly, or at least correctly from the standpoint of the CPA exam question writers. Okay, let's have a look here. Now, they tend to group these in sets of 3 or 4. And so our first set, number 12, we see the following questions deal with audits by CPA firms. Again, choose the best response. Now, for some reason, they letter the questions and number the responses. It's the opposite on the CPA exam, just like on all other multiple choice exams I've seen. So if I refer like to answer B, it means number 2. Okay, you'll get it. So first of all, here in questioning, which of the following best describes why an independent auditor is asked to express an opinion on the fair presentation of financial statements? This one where we kind of have to read through it. Well, we see answer 1, it's difficult to prepare financial statements that fairly present a company's financial position, operations, and cash flows without the expertise of an independent auditor. Kind of sounds tempting, but I'll tell you, is the auditor there to prepare financial statements? No. So that rules this out. I flip the next page and look at the other responses. We see number 2 is management's responsibility to seek available independent aid in the appraisal of financial information shown in its financial statements. Not really. No, that's not really describing it. It's gathering information. It's not appraisal. This almost sounds like you're trying to appraise an asset. Number 3, the objective of an independent party is needed because a company may not be objective with respect to its own financial statements. Okay, that sounds good. But let's just read number 4, just to make sure. It's customary courtesy that all stockholders of a company receive an independent report on management stewardship of the affairs of the business. Well, first of all, is it a customary courtesy? It's not a courtesy. It's a requirement. If a company is publicly traded, it's required. If not, there may well be other requirements. So, and it's not just an independent report on management stewardship, the affairs of the business. That's not what an audit report really is. It's about the financial statements. Are they fairly stated in accordance with GAAP or not? And again, we'll be studying those reports tonight as we go over chapter 3. So I think we can safely pick number 3 here. Right. Then B. Excuse me. Which of the following professional services is an attestation engagement? So let's see. Number 1, consulting service, rule it out. No, an attestation engagement means that we are going to give some conclusion in written form. And an audit is a type of attestation engagement. So we can rule number 1 out. We're really looking for an audit. Number 2, an engagement to report in compliance with statutory requirements with law. Okay. That, yeah, sounds really good. We will see more about special types of reports to report on compliance later in the course. So I realize we'll relate to this more later, but let's just kind of hold that one back there. Number 3, an income tax engagement, prepare federal and state tax returns. No, definitely not. It's just tax work. Or number 4, the preparation of financial statements for a client's financial records. Well, which type of engagement does that sound like? Compilation. That's not it. So yeah, it's number 2. So accountants don't just audit numbers. They also audit things like compliance. In fact, compliance over the years has grown bigger and bigger and bigger in auditing. So here at Florida Southern, like with a lot of other organizations, we actually have a combination: financial statement audit and compliance audit, making sure we comply with things such as what the Federal Department of Education says that we must do for student financial aid. As I've said, over 600 different compliance requirements. So it's big. But if we don't comply with everything that the federal government says we should, they can try to claim some of that money, to claw it back, require us to repay it. Just like, oh, you didn't check an individual student's registration after ad drop, which ended yesterday. They dropped some hours and they went below 12 hours. They're not full-time anymore if they're undergraduate. That means that we must reduce their financial aid award. And if we didn't do it, well, the federal government is going to claim that money. It's actually called question cost. So federal government questions it. That means if they succeed and produce some evidence that you did not comply, you owe that money back. Then C, which of the following attributes is likely to be unique in the audit work of CPAs as compared to the work performed by practitioners of other professions? Yeah, independence, number one. Very much so. So that's always a safe answer. Competence, no. Other professions are also competent. Do professional care? Oh, other professions exercise that too. Complex body of knowledge? No, we're not the only ones with that. So number one. In fact, sometimes you'll see a similar question on the CPA exam. That's always the answer. So it's good when you know what the answer always is. And on the CPA exam, there will be a lot of similar questions to past questions, same types of answers, or very often identical question to what they've asked previously. Then number 13, dealing with types of audits and auditors. So first of all, operational audits generally have been conducted by internal auditors and governmental audit agencies, but may be performed by CPAs. A primary purpose of an operational audit is to provide, what did you say here? Okay, number 2, a measure of management performance and meeting organizational goals. I'm not too concerned about operational audits, just kind of know what they are. They don't test much about them whatsoever on the auditing section of the CPA exam. They might have a basic question that just tests that you know what an operational audit is. B, which the following best describes the operational audit. And what'd you say? 4. It concentrates on seeking aspects of operations and which waste could be reduced by the introduction of controls. Remember, we said that operational audits deal with economy, effectiveness, efficiency. Well, they're trying to get us to do things better, be more lean, save money in the end. So that's why. Now C, compliance auditing, such as complying with federal requirements or complying with a contract or with debt covenants and a bond indenture, like you must maintain a bond sinking fund of however much, so the bondholders can see that you can pay the bonds back. So here's where the auditor goes in and checks that compliance. So compliance auditing often extends beyond audits, leading to the expression of opinions on the fairness of financial presentations, and includes audits of efficiency, economy, effectiveness, there are those terms, as well as, what'd you say? 2, adherence to specific rules or procedures. Just like those federal compliance requirements, or just like those debt covenants. So any questions there on those multiple choice questions? All right, let's go over to chapter 2. Take a look at the homework over there. And chapter 2 homework starts on page 41. So with review questions, we have a few of these. Let me turn the page. Looks like they were pretty basic. Did you have any questions on any of the review questions for chapter 2? Any questions? Okay. Multiple choice questions. First of all, number 13. Following questions deal with auditing standards. So, first of all, which of the following best describes what is meant by U.S. auditing standards? Now, this answer may not be very obvious at first blush. Any guesses, first of all, as to what it is? Okay, it's going to be number 2. Here's why. Auditing standards, they really do provide us with some measure of quality for our work. In fact, on a CPA exam, when they have this question on it, the answer is always something about quality. So some measure of quality. Just note. So if you think about it, if the auditor has complied with auditing standards with GAS, so the auditor's done everything they should. They followed those basic precepts we saw on page 35. They followed the much longer statements of auditing standards, which we know are codified by topic or by AU-C section. Well, if they comply with these standards, that means they've done quality. If they didn't comply, they didn't do quality work. So that's what they're trying to test about. They're trying to get this concept of quality that we saw a lot of in chapter 2. So just know that's always the answer. Again, we're looking for common patterns here, and that's one. Again, number 2. Now, in B, the responsibilities principle underlying AICPA auditing standards, again, on page 35, includes a requirement that is number 3. Professional judgment be exercised by the auditor. So let's use good judgment. We're professional. Hopefully we got good judgment here. And number 3 was general character of the responsibilities characterized by the performance principles. That's number 3. The criteria of audit planning and evidence gathering. So here's how we plan the audit, and here's how we go about gathering evidence. Again, on page 35, those are just general concepts, general precepts. The much longer statements of auditing standards are all based on them, though, all consistent. Then number 14. The following questions concern quality control statements. So always choose the best response. So first of all, in A, the nature and extent of a CPA firm's quality control policies and procedures depend on. Now, this format is very common on CPA exam, format of answers. Kind of like the extended true-false question. Now, one strategy problem that some students have, especially under test pressure, is that they get bogged down in the yeses and nos. Okay, I guess that's easy to do. Best thing, solve that, cover up those answers, and just answer each heading, 3 here in this case, independently. So, what's going to influence the nature and extent of a CPA firm's quality control policies and procedures? Would you say the CPA firm size? Yes or no? Yeah, it'll influence them. The nature of the CPA firm's practice, will they influence them? Yes. And cost benefit considerations, and some of this we'll see more later in the course, but just trying to look ahead now. Well, cost benefit considerations, yeah, we're not going to do something in general in business unless it's right. Benefits have to be at least equal to cost, hopefully greater. So we're looking for yeses all the way across, and that would be answer 1. By the way, on questions like this, the most common answer is yes all the way across. So if in doubt, pick the yeses. And why do you think the second most common answer is? No all the way across, yeah. So that way you can always make an educated guess. Hopefully get it right. Or at least increase your chances of getting it right. Then B, which of the following are elements of CPA firm's quality control that should be considered in establishing its quality control policies and procedures? Here we have another one of those questions. Human resources, was that one thing that we saw that's considered? Yes. Again, covering up those yes and no's so that we don't get mixed up under test pressure. Monitoring. Yes. Did we see engagement performance? Yes, we did. Yes is all the way across again, so we go for answer number 2. Again, that most common answer. Yes is all the way across. If they'd really wanted to trap the unwary, those who don't know the answer at all, maybe they should have put one in here that had no's all the way across. Trust me, a lot of people would have picked that off the bat if they didn't know. Then C. One of the CPA firm's basic objective is to provide professional services that conform with professional standards. Reasonable assurance, oh, there's that term. So not absolute assurance, not 100% guarantee, but only a 90% some odd guarantee. That's what we do in auditing. Again, we don't lock ourselves in to absolute perfection. Try to attain that, bless you. So, reasonable assurance of achieving this objective is provided through, number 1, a system of quality control. So any questions here on any of those multiple choice questions? Right? Then we have one short case here in chapter 2. It's on page 45. And it's number 20. Now, there's a little asterisk here, and that tells us in the footnote, based on AICPA question paper. Okay, what that means is it's based on an old CPA exam question. Okay, that's good. So we have the text of a little case here. A couple of paragraphs, but I always find it very helpful to read the requirement first so that we know what we should be looking for as we then go back and read the text of the case. So let's look at that requirement first. So briefly describe each of the principles underlying AICPA auditing standards and indicate how the action or actions of Holmes as the CPA result in a failure to comply with each principle. Organize your answer as follows. So a brief description of the principle, then Holmes' actions resulting in failure to comply with the principle. And actually, when this was tested on the CPA exam, they didn't have you list those standards. And they're not going to on the CPA exam. No. That's a memorization task. Instead, they wanted you to read through the case and first say the wrong actions of Holmes. Listen. Then describe why each wrong action of Holmes was wrong. So briefly tie that back to the auditing standards. We can do that. Let's have a look here. If we go back to the start, we've got Ray, the owner of a small company, asked Holmes, a CPA, to conduct an audit of the company's records. Now, there's something in this first sentence that's not in the official answer key in my accounting lab, but I'm sure not comfortable with it. How do you feel about an audit of the company's records? Not good. What are we actually auditing? Oh, and I'm sorry, if you're online, I have not been sharing my screen. Let me just, share this here. All right.
I have the book pulled up. I don't know about Caden,
Oh.
but I have the book pulled up.
All right, I'll make sure the Caden is okay here. All right, there. So we're not actually auditing the company's records like its books. Instead, we're auditing financial statements. Now, I bring this up because companies' bookkeeper may have done a great job. Those books might be just fine. So, journal entries are great. Ledger, accounts in there are great, blah, blah, blah. But the financial statements may not have been properly compliant from those books. And even if the numbers are right, there could be other problems in financial statements, such as improper disclosure. And usually with disclosure, completeness is the problem. Not everything is disclosed that should have been. So auditing financial statements is just much more than making sure that the books are right, the numbers in the books are right. Much, much more. So I would put down there that Ray should be auditing financial statements. And the reason is we're told in the auditing standards that we are there to audit financial statements. That's our responsibility. Then we see that Ray told Holmes that an audit was to be completed in time to submit audited financial statements to a bank as a part of a loan application. All right, that's a common reason. The bank wants this audit. Obviously, Ray does not have a publicly traded company. So the reason he's having an audit is due to the bank. That's fine. Then we see Holmes immediately accepted the engagement and agreed to provide an auditor's report within 3 weeks. Does that sound like a good idea? No. That is lack of due care and client acceptance. We'll see more about that in chapter 8. But we should not immediately accept a client. We should check them out. We don't want to associate with a client whose management lacks integrity, a shady client. Again, more about that later, but check them out first. And then agreed to provide an audit report within 3 weeks. How does Holmes even know that he can do that? He hasn't looked at the client's financial statements or anything else. So that was just kind of a quick answer there. And that's lack of due care and client acceptance and improper planning of the audit. He hasn't planned anything and he gave an answer as though he had. Not good. Then Ray agreed to pay Holmes a fixed fee plus a bonus if the loan was granted. Two things wrong there. One is substantive in nature and the other is grammatical. Well, Ray said, Holmes, I'm going to give you a fixed fee for this audit, however much it is. But if the bank says, yeah, we'll grant the loan to me, then I'm going to give you a bonus. So, hint, Holmes, I want you to say only favorable things in the audit report. Give me the nice, clean audit report. We'll see tonight in chapter 3. Everybody wants that says, oh, this client's financial statements, in our opinion, are only stated in accordance with GAAP in all material respects. Does that really motivate Holmes to dig very deeply in the audit, to gather a lot of evidence? No, he'd probably not rather gather that much evidence, turn a blind eye to things, plus one worked out hard. The independence of Holmes just went out the window here, because obviously Holmes is very, very motivated to say everything's okay in the audit report. We know in an audit, saw last week, that we can never accept a contingent fee for anything. So it's contingent upon something happening. In this case, the thing that's happening is a clean audit report. So never a contingent fee in an audit. Violates independence. Then Holmes hired 2 accounting students to conduct the audit and spent several hours telling him exactly what to do. Well, I'm glad he's giving him the opportunity here, but to conduct the audit, that's not good. The students obviously do not yet have sufficient competence and expertise to do the audit. He could have hired them, let's say, as interns, good, but as a CPA, he needs to be the one that's supervising this process. He should be out there helping. He should be the main one who's conducting the audit. But it sure doesn't sound as though he is. He's just turning them loose. He's gotten cheaply. Not good. Not good quality control either. So then Holmes told the students not to spend time reviewing internal controls. Wrong. Because we know from the standards that we must review internal control. If internal control is good, great. Then probably, excuse me, the client's financial statements are okay. If internal control is poor, probably the client's financial statements are bad. Or at least there's a bigger chance. In the latter case, we definitely got to do more audit work. So it was wrong to ignore internal control. But then he said, but instead to concentrate on proving the mathematical accuracy of the ledger accounts and summarizing the data in the accounting records that supported Ray's financial statements. Does that sound like an audit? No, he's not gathering any evidence. So we know in an audit that we must gather and evaluate evidence to find out if the client's financials are okay. Not good whatsoever. Instead, this sounds to me like a compilation. Well, the students followed Holmes' instructions. Good for them. And after 2 weeks, gave Holmes the financial statements, which did not include footnotes. That latter part is wrong. Financial statements must have proper disclosure. At least there will be some footnotes there. Maybe not many for a small company, but some sort of disclosure. If there is not sufficient disclosure, those financial statements are not in accordance with GAAP. Because GAAP says you must have sufficient disclosure. We'll see that tonight in chapter 3 of audit reports. But if there's not sufficient disclosure, you can't give the nice, clean audit report that everybody wants. So we see Holmes reviewed the statements. Okay, I don't know what I did there, but well, then he prepared an unmodified auditor's report. Unmodified, we'll see that term tonight, means a nice clean opinion, again, that everybody wants. We did not modify the opinion to state something was wrong. Well, no wonder he gave them this nice clean audit report, because after all, Ray said, I'm going to give you more money if you did. Then we see the report did not refer to GAAP, bad, clear-cut violation, or to the consistent application of such principles. Well, tonight with audit reports, we're going to see that if there's been a change of accounting principle, like from LIFO to FIFO for inventory valuation, or from straight line depreciation to units production depreciation, we must bring it out in the audit report. So we've got to compare this year's accounting principles chosen by management when they have a choice like that to their choices for last year. Sounds like the students didn't do that. Any questions there on number 20 or anything else? Well, I know one other thing I can bring up. Okay. By the way, last sentence in the first paragraph, I said there's a grammatical error. So Ray agreed to pay Holmes a fixed fee plus a bonus if the loan was granted. What's grammatically wrong there? Just kind of one of my pet peeves. I know. Okay, what's wrong is if the loan were granted. Yeah, it's conditional on if. And does anybody know why that should be were? Does anyone ever conjugate a Romance language? Conjugated verb sentence. Okay. That's called the subjunctive mood. So it comes from Romance languages, and that is wrong. And it's not very well taught in school. It just isn't. Yeah. My friend Keith Honeycutt, English professor. Does anybody know Keith? Okay. Well, really good person. But he and I both serve on the tenure promotion committee here at Florida Southern. And when we look at applications and faculty members put together, we constantly see violations of the subjunctive mood. So he's an English professor. He looks at details. I'm an accountant. I look at details. So we have a lot of discussions about grammar, and especially subjunctive mood. It's just kind of a pet peeve, both of us. All right. Oh, I know another pet peeve of both Keith and me. It is this. I'm just going to put asset there just so that I've attached that adjective to something. So if we have a non-current asset, a long-term asset, we can also say that that asset is, how do we say this? Yeah. It's long-lived. Yeah. So make sure you say it properly. And I bring that up in accounting because that is actually a term that we sometimes use. And I've heard accountants in professional presentations say long-lived. And always there's some accountant out there that is looking at that detail. And of course, every OCD is, well, let's face it, how many accounts are OCD? I think all. How many English professors are OCD? I think all. How many librarians? I think all very detail-oriented professions. So those details annoy us. So, well, that very OCD account is going to call out the error. They will say, no, it's long-lived. So don't be embarrassed, okay? That's why I say that. It's not only my pet peeve, I guess, or one of my pet peeves. Well, do you have any other questions about chapter 1 or chapter 2? All right. Well, let's go back to the handout here. And again, we see that chapter 3 is the next thing we're going to look at. We also know from the syllabus, chapters 4 and 5 are strictly background chapters. So I don't go over them, just read them when you have a chance. No homework, no quiz from them, and I won't test you on. Just that. So here in chapter 3, we're going to study audit reports. So in chapter 3, we're going to look at audit reports, which are really the end product of the auditor's work. And this is where we're going to give our opinion as far as whether we think that that client's financial statements are okay. Excuse me. So, are they fairly stated in accordance with GAAP or not? That audit report is the end product of the auditor's work. In other words, of all this evidence gathering we're going to go through, we'll see more details about that later in the course. But the auditor has a very sound basis, having a lot of evidence to back up what they're saying in that audit report. They'll document the evidence very carefully. And we'll see, again, all the details of that. So suffice it to say, we'll do a lot of work behind this audit report. But that audit report, being the end product of the auditor's work, it's extremely important. There's a lot of risk attached to it. Because after all, that is our primary means of communication to investors and others who read those financial statements, creditors too. So if we say something wrong in the audit report, if we did not have sufficient evidence to back it up, ooh, we could get in trouble. So a very high risk venture. A lot of risk attached to it. It's one of the reasons auditing pays well. But with risk. Now, with the audit report, since it is so important, how much do you think they will test you on it on the CPA exam? A whole lot. Oh, yes. We need to know this chapter backwards and forward. Well, if we don't, we've lost some points there. We will also see other types of reports as we study chapter 25 toward the end of the course. So a lot of things we do in auditing is based right on this report. And also this report, excuse me, is going to reflect what we do to get here in the report. We'll say some things about evidence gathering in it, for example. So what we have in the audit report in the way of language is very carefully crafted. It's been fine-tuned over the years, and this means this audit report, well, it's a culmination. A lot of years of, oh, this is the best practice. Or, no, let's don't do that. Ooh, that could even result in a lawsuit against the auditor. Let's not say that. So, very, very sound reasoning went into this, shall we say. The auditing profession regards it as, well, a real point of pride, but again, a real source of potential risk. So we have to be careful here. Now, with the audit report, It may sound rather strange, starting off the course with the end product of the auditor's work. But when we reflect on that, that's not strange at all. Because if we know the end product of the auditor's work, then in further chapters, we'll step back and see how we get there. Everything will make sense because it all falls into place in the road map to this audit report. So it's a good place to start. With chapter 3. Chapter 3 contains the most information of any chapter in the course, just to let you know. So it is a bulky chapter. A lot of details in here. Audit reports are not difficult. They really aren't. The difficult thing is dealing with those details, remembering them, and just kind of integrating them in our minds. Well, that means you'll need to review this chapter pretty carefully, but once it clicks, it really, really does click. That's good. Just to let you know, a lot of details here, a lot of material. But that's okay, we can master it. It'll pay off on the CPA exam. It'll pay off in the rest of the course too, because, well, we'll understand how we're going to get to this audit report. So let's have a look here at audit reports. And we're going to start off with that nice, clean audit report. Clean opinion, as we often say, because an audit report really is the auditor's opinion. So the nice, clean, unmodified audit report that everybody wants that says these financial statements are fine. They conform to GAAP in all material respects. So we'll see why it's carefully crafted as it is, why it's worded as it is, why we say what we do say in it, why we don't say some things in it as well. Then we'll turn our attention to what happens if not everything is okay with the client. So we'll see how we modify this audit report if we find a material misstatement with the client's financials. Now, hopefully, that client's going to clear up that misstatement. Audits are often a big cleanup act. Then we give them a clean opinion. Once in a great while, a client cannot correct it for some reason, or the client's too stubborn. And may I add dumb to correct it. Because if you're an auditor, do you want people to see that you have this client that doesn't correct a misstatement in financials you pointed out? No. If you're a stockholder, do you want to buy stock in that client? No. We'll see a couple of examples here tonight that are going to stand out to us. Another thing that could be wrong is the scope limitation on the auditor's work. We cannot examine all the evidence we want. In that case, we must also modify the report to say this is wrong. We have scope limitation. We add a misstatement. We'll see how we modify. And another modification when something's wrong is when the auditor lacks independence. See why that could happen. After that, we'll see 5 other modifications where maybe nothing's wrong per se, but there's something we've got to bring out in the audit report. We'll see why. Not necessarily a bad thing. So, start off with a clean opinion. We'll learn it very well. Then we'll go to modifications of that clean opinion. On the CPA exam, they'll test all that. Believe me. They really want to see that you understand audit reports. They know that if you don't, your understanding of the rest of auditing is lacking, quite frankly. So here with audit reports, let's first discuss that nice clean audit report that everybody wants. So we could say standard unqualified audit report, or unmodified audit report, or we could say the clean opinion or audit opinion. Audit report and audit opinion are used interchangeably in practice. Well, this is the type of report issued to over 98% of all clients, because clients usually fix whatever's wrong before the auditors complete field work. Again, audit reports are very important, much risk. Auditors main communication are readers. So, in an audit, like I said, an audit is often a very big cleanup act. The auditor finds something wrong. So here is the statement in your financials. It has resulted from a posting error of some kind, or usually posting errors. Errors tend to repeat themselves or just be a pattern. So somebody didn't post transactions to the right account for whatever reason. A good example is with repair and maintenance expense. The same vendor that repairs and maintains assets for you, like computers, you may also buy assets from them. So here comes the invoice from that vendor. This bookkeeper posted that invoice to repair and maintenance expense because they're used to doing that for this vendor. So they expensed off the computer. That's wrong. They should record as an asset. They should capitalize. Common thing to happen, or vice versa. Something should have been recorded as that, or something that should have been recorded as repair and maintenance expense gets capitalized as an asset by mistake. So the auditor finds things like this. Very likely. However, a cooperative client says, "Oh, we're glad you did. We'll fix this. We're motivated to do so because we want our financial statements fairly stated in accordance with that." Auditor says that they don't fix material mistakes. Client refused to do that for whatever reason. Well, then the audit report is going to be modified. If we modify it like that, we often say we have qualified it. Sometimes students get confused, by the way. They see unqualified audit report, and then they see it's a good thing. Well, it is, as in if we give our unqualified score to something. In this case, the auditor is giving their unqualified score to the financials. But I've had students say, "Oh, it sounds like the client is unqualified to be in business." No, that's not what it means. Or the auditor is unqualified to do the audit. No, that's not what it means. But unqualified, it can have two entirely opposite meanings, as unfortunately many English words can. I was keenly aware of that teaching in China because Chinese, they don't have that problem. So I had to explain why sometimes one English word can have many different meanings. Sometimes some of those meanings are opposite of each other. Or conversely, two or more words in English mean the exact same thing. They're synonyms. And these two concepts are very difficult for native speakers of a lot of other languages to learn. They really are. Now, excuse me. Looking here in A, if we see a clean report, company got a nice unmodified audit opinion. Well, we know some signals that we can read right away. We just know these concepts. The clean opinion signals, right at first blush, reasonable assurance. So again, not 100% guarantee of such concepts the following. First of all the generally accepted auditing standards, GAS, all the SASs met, statements of auditing standards, and also, by the way, the PCAOB, or Public Companies Accounting Oversight Board, kind of goes along with the SEC, but no one's quite sure what the role is. It's been very confusing. It was set up by the Sarbanes-Oxley Act, created the PCAOB. but they do promulgate or put out some standards. Well, if we're auditing a publicly traded company, we've got to follow. More about that in the graduate level auditing course. So, as an auditor, sum it up to say that we followed all authoritative guidance that we should. Well, then number 3. This also means, number 2, there are no material scope limitations on the auditor's work. We could examine all the evidence we felt we needed. Now, there might be a little scope limitation. For example, maybe a receipt no longer exists for a little purchase. Somebody threw it out. Okay, they throw out a piece of evidence technically, but it's a small purchase, it's not material. But if we have lack of documentation for a much bigger issue, that can be a material scope limitation. A major chunk out of the auditor's work. Auditor could not examine material evidence they felt they needed. Again, later, we'll see how we modify the audit report if there is a material scope limitation. And number 3, this also means the financial statements do not have a material departure from GAAP. How many financial statements do you think will have some immaterial departure from GAAP? All. They're not perfect. It's the nature of the game. There will be some mathematical errors in there someplace, some posting errors, maybe some software errors. Okay, as long as any resulting misstatements are not material, no, that's okay. So, if they're bigger, therefore material, that's when we worry about them as an auditor. Again, later in this chapter, we'll see how we modify the audit report if we have material departure, a material mistake in the financials, and the client did not correct it. Now, reading on, this also means that all the financial statements are present. Balance sheet, income statement, statement of retained earnings, or statement of stockholders' equity. Either one's okay, and statement of cash flows. If one is missing, that is a violation of GAAP, because GAAP says all those need to be there. Otherwise, we have what is known as an incomplete presentation. Not good. Can't give a clean opinion then. Violation of GAAP, and it's material. By the way, this also means the financial statements have adequate disclosure. We know that there's not adequate disclosure in the financials. Violation of GAAP, because GAAP says there must be adequate disclosure. And another signal we know right off the top with a clean opinion, number 4. The auditor is independent of the client. If we are not independent, again, we'll see a special type audit report that we have to give. It's going to be a really short and simple one. I'll show you after a while. And number 5, this also means the client has sufficient internal control and sufficient integrity to permit an audit. If they don't have sufficient internal control, if it's really bad, you can bet their financial statements are all messed up. We don't want to audit. Well, not only would they be a mess to audit, but they'd be high risk too. So usually that doesn't, but it could. It also means the client has sufficient integrity. If a client does not have sufficient integrity, we find that their board of directors and their top management team are all a bunch of fraudsters. Do you think we want to audit them? No. In fact, we should not accept it. In chapter 8, mentioned a little bit with quality control, that we do check in clients. We never accept a client if we're not comfortable. So we would not be comfortable if we had a shady client. Nope, pass that one up. So we'll take a look at some details of the standard unqualified audit report in just a moment. So that nice clean opinion. Now, I'll go to that in the book. And I'd like to look at the first three things here first. We're going to note the sections of it. So first of all, we're going to have a title. It's going to say, usually independent auditors report, or it may say report of independent accountants, or report of independent CPAs, something of that nature. But it will always refer to independence. Always. Then the address. So to whom are we considering to be the primary audience of this audit report? Well, a publicly traded client, that is to the client stockholders, preferably. Sometimes it's not. Sometimes it's just to the company name. Okay, I guess by default that means stockholders. So if we see it simply addressed to publics, okay, we'll go with it. Stockholders, employee stockholders in public's case, but preferably as stockholders. Here's why. Stockholders are the owners of the company. They are really the ones who have to put up with things in the end as their stock price goes up and down. They own the company, they call the shots in the end. And so hopefully we address the audit report to them. We would never address the audit report to managers. Never someone like the company president, or CEO, chief executive officer, or CFO, chief financial officer. No. In fact, we're reporting on their performance again, at least when it came to financial statements. If we address it to them, that's showing really lack of independence because they are biased. We know that they sometimes like to induce information risk, report financial statements that are not quote unquote accurate. Sometimes they like to fool stockholders. We saw again last week, stockholders are principals or owners, managers or agents doing things for the stockholders. So we don't report to the agents, we report to the stockholders. Now, next, we're going to see an introductory paragraph in the audit report. It's a factual statement about the audit. So with that, let me turn to the audit report in the book. And again, okay, that was page 48. Let me flip over there. So I'm going to refer here to figure 3.1, standard unmodified opinion audit report on comparative statements. Okay, comparative statements means 2 or more years presented in comparison with each other. Good. For a U.S. non-public company. So, not publicly traded. Its stock, also its bonds, are not sold on a marketplace like Wall Street. So it's privately held instead. Therefore, we will go with AICPA auditing standards. So the SASs, if it were publicly traded, technically we would go with PCAOB standards. But the PCAOB, they haven't set any standards of their own. They just adopted the AICPA standards, and that's good. So we don't have 2 different sets of standards to study. All right, but just a little note, if it's publicly traded, we're going to see PCAOB standards referred to instead of GAAS, generally accepted auditing standards, GAAS being the output of the AICPA. Okay. So this audit report, we see this was written on the CPA firm's letterhead. That's kind of optional, but it's a good idea to have information about the firm at the top of this. but not totally required. Then what is required is the report title. So independent auditors report. Good, they're independent. Then the address. We see they address this to the board of directors and stockholders of General Ring Corporation. So, okay, the board of directors too, that's fine. But definitely the stockholders. They're the actual owners. And this company's name is General Ring Corporation. Well, here's the introductory paragraph. Just states what went on. We have audited the accompanying balance sheets of General Ring Corporation. As of December 31st, there are 2 years presented there. Good, comparative financials. So their fiscal year end is December 31st. And the related statements of income, changes in stockholders' equity, and cash flows for the years that ended, and the related notes to the financial statements. So we cite all years of financial statements presented. And we audited not only them, but also related disclosure, because that says you've got to have that disclosure. Normally, we start off saying the balance sheet and then the other financials. That's not an absolute requirement, but it's a really good best practice. Here's one. The balance sheet is really the most basic financial statement because it contains all real accounts. So not zeroed out year ends, not like nominal accounts. So very important, carrying over from year to year, whereas the income statement, all those accounts are zeroed out year end, they're closed out. So we have a fresh start with the income statement, not so with the balance sheet. So we see some other material here. We see next section of management's responsibility for the financial statements. Let me flip back to our outline next. So that's number 4. Let me just say a few things about it, then we'll look at the details of the book. So number 4, management's responsibility for the financials. This section is important as it emphasizes management's responsibility so that the auditors are held accountable for them. Management has some things that it has to do. It's got to do them on a daily basis. The auditor's not there 365 days a year. We'll see in just a moment how we delineate management's responsibilities versus ours. Audit reports refer to United States GAAS in this section. However, for SEC clients, though, remember again, the PCAOB's auditing standard number 1, you don't have to know that, but it comes from standard 1, requires GAAS to be replaced with the standards of the PCAOB. So you always know if we're dealing with a publicly traded client, PCAOB we will see, or a privately held one, we'll see GAAS in that case. So now let me come back here to the book. We'll take a look, excuse me, at this management's responsibility section. So management is responsible for the preparation and fair presentation of financial statements in accordance with accounting principles generally accepted in the United States of America. This includes the design, implementation, and maintenance of internal control relevant to preparation and fair presentation of financial statements are free from material misstatements. Okay, always have material there. Giving ourselves some wiggle room. Don't sweat the small stuff. Immaterial stuff, big deal. Whether due to fraud or error. Fraud, somebody meant to make that misstatement. They're deliberately misstating financials. Bad. However, most misstatements are innocent. They're totally innocent errors. More about that later in the course, but So management, they're responsible for internal control on a day-to-day basis. They've got to have good internal control. They've got to, in the end, prepare financial statements that are okay. But these are management's responsibilities. We are very careful to say that, because if we do not, the general public will tend to think that these are auditor responsibilities. Well, excuse me, we can't be there again 365 days a year. So we make it clear that these are management's responsibilities, not ours. We don't wish to get one. Very important that we have this management's responsibility section. And then next, we have a section about the auditor's responsibility. So what are we responsible for? So again, delineating our role separately from management's role. Let me come back to the notes. And have a look at number 5. Then I'll go back to the book and look at some detail. So number 5, the auditor's responsibility section. Well, this section contains the auditor's responsibilities and the engagement. There are 3 paragraphs. The middle paragraph of this part is called the scope paragraph. And it's a factual statement about what takes place in an audit. So the scope of the auditor's work, what do we do as we're out there doing an audit? We need to inform the general public. We'll note this term includes the term reasonable assurance. Okay, again, which means the auditor will not perform a procedure unless the benefits exceed the costs. That's in contrast to absolute assurance, which would involve investigating everything. So absolute assurance, trying to give 100% guarantee, and it's not attainable. So instead, again, we only provide reasonable assurance, a 90-some-odd% guarantee. And again, only of material things. Immaterial, we don't worry about that. By the way, for an idea of the expectation gap between the auditing profession and the general public, consider the point of view of each. Well, we're an auditor, we know our limitations. However, if we did not state those limitations here, the general public is going to think, again, we're superhuman. We can find everything. We can make sure those financial statements are absolutely correct. Well, that's just not attainable once again. But that's why the auditor is very careful to state what they can and cannot do. Let me come back to the book here and take a look at that in the audit report. So again, this auditor's responsibilities section, 3 paragraphs, middle one being the scope paragraph. So it says, first of all, our responsibilities is to express opinion on these financial statements based on our audits. Okay, that's what we're there for. Very important again to state what we need to do, what we're responsible for. We conducted our audits in accordance with auditing standards generally accepted in the United States of America. So again, U.S. GAAP. We know it's that it's a privately held company. If we're publicly traded, again, we would cite standards, the PCAOB instead. Always the signal there. Well, those standards require that we plan and perform the audit to obtain reasonable assurance, there's that term, about whether the financial statements are free of material misstatement. So saying reasonable assurance, saying material misstatement, we're saying not everything's perfect. Don't expect absolute correctness or perfection in these financials. We're allowing ourselves some wiggle room. They're always going to be, for example, immaterial misstatements. Well, nature of the game. Then the scope paragraph. It talks about the scope of our work, what we did basically during the audit. So we see an audit involves performing procedures to obtain audit evidence about the amounts and disclosures in the financial statements. So we'll see a lot of evidence gathering throughout the course. Evidence as to whether those financial statements are okay or not. Well, the procedures selected depend on the auditor's judgment, including the assessment of the risks of material misstatement of the financial statements, whether due to fraud or error. Okay, those terms again. In making these risk assessments, the auditor considers internal control relevant to the entity's preparation and fair presentation of financial statements in order to design audit procedures that are appropriate in the circumstances, but not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. Accordingly, we express no such opinion. Audits also include evaluating the appropriateness of accounting policies used, like LIFO versus FIFO, which one's better, and the reasonableness of significant accounting estimates made by management, just like residual value for depreciable assets, useful life for depreciable assets. Are these okay or not? The auditor needs to look. As well as evaluating the overall presentation of financial statements, make sure that's okay. So those are things that we have got to do in the audit. By the way, this thing about internal control, we do not express an opinion on it, is a further signal of a privately held company audit. For a publicly traded client, we will provide an opinion about internal control. It's mentioned in Chapter 3. There's a sample of one, and we'll talk more about it as we talk about internal control later in the course. Just glance over the report about internal control, where the auditor gives an opinion only for a publicly traded client. You'll see it in the book. Just glance at it. For a privately held one, we don't do so. Then, excuse me, that last little paragraph here in this section. We believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our audit opinion. So sufficient evidence, we gather none. Just like we're confirming accounts receivable, we confirmed a big enough sample. The evidence is appropriate, it's what we need. It's high quality. And it's low quality, ooh, that's not going to help us out very much, but high quality evidence. Us line, again, confirming accounts receivable. Those confirmations come to us directly from an outside party. The client never touched them. So the client will never have the opportunity to change them, to make them biased. Very high quality evidence, very appropriate for the auditor to use. So, the evidence in Chapter 7. Well, then lastly, we see the auditor's opinion. Let me come back here to the notes and look at this verse, number 6. Well, the opinion section. It gives the auditor's conclusions about whether the client's financial statements are fairly stated in accordance with GAAP. We're going to note that it does not include such terms as certify, correctness, accuracy, freedom from fraud or error, etc. We never use such absolute terms. There's no wiggle room there. They imply that financial statements are absolutely correct. We would lock ourselves in. I bring those terms up because many years ago, when audits became a big thing after the Securities Acts of 1933 and 34 were passed, those terms used to be used a lot in audit reports. We never do need. Too absolute, to implying that, well, we give 100% guarantee. Not good. So instead, we include such terms as fairly presented in accordance with GAAP, reasonable assurance, material, test bases, etc. So again, not as precise, we give ourselves some wiggle room. So these are reasons why those financial statements are not perfect. By the way, test basis, that implies that we don't look at all evidence. For example, we don't confirm all accounts receivable. That would be very expensive. Instead, we confirm a sample of it. Well, you know, we might not confirm an account receivable that has material misstatement in it. Well, that's okay. In any profession where sampling is used, this can happen. Similar things. So sampling is an inherent limitation of sampling that you might get the wrong conclusion sometimes. Then, finally, in the United States, appears again to emphasize that American GAAP is being used. So let me come back here to, once again, the audit report. Let's look at this auditor's opinion section. So opinion. In our opinion, the financial statements referred to above present fairly in all material respects. The financial position of General Rain Corporation, there it is again. There are the dates of these two sets of financials again. And the results of operations, okay, tying back to the income statement, statement of cash flows, whereas this financial position tied back to balance sheet. So we're paralleling that first paragraph. Then it says, and a result of, and then it says, and cash flows, okay, paralleling the statement of cash flows for the years that ended, just to make sure nobody's confused there, same years, just being precise, in accordance with accounting principles generally accepted in the United States of America. So US GAAP. Now, just under that, we see signature and address of CPA firm. Sometimes we see a signature, sometimes we don't. That's okay. Then we see the audit report date. The date the auditor has obtained sufficient appropriate evidence. Now, we see it's February 15th. It's a month and a half after fiscal year end. Do you think the auditor could ever wind up the audit right on December 31st, fiscal year end in this case? Can't wrap up loose ends. Just like with a checking account the client has. Deposits in transit was not cleared by December 1st. You're in deposits in transit? No. Outstanding checks at fiscal year end would not have cleared right at fiscal year end either. So if you ever see an audit report date, which is dated fiscal year end, it's wrong. Also, often in audit reports, and this is optional, but the last 3-4 years, I've noted that there is often a little sentence down here by the auditor that we have audited the client since whenever. CPA firms who have audited the client for a very long time tend to put that optional statement down there. Well, in the case of Publix, their auditor is KPMG. Bless you. And at the bottom of Publix's audit report, KPMG says, we have audited the client since 1961. Over 60 years. 62 years, to be exact. And we can really note from that that there are a lot of long-term engagements, CPA firms with clients. Well, clients really don't like to change CPA firms unless they have to. Every client has their own way of doing things. Bringing in a new CPA, they've got to train. So there's a definite learning. They don't like that. But it means auditors are so well trained in the end that some of them will actually go to clients for jobs if they decide to leave public accounting. All right. It happens. Now, back here on the handout, just finishing this up, name the accounting firm. Well, should it be signed in longhand? That's the preferred way of doing it. It used to bother me who actually signs this. Well, the answer is just someone with good handwriting. Or you can type script there. Or you could just type regular letters there. But some people just like that signature. Should also include the same date of the CPA firm. Then the report date is stated at the end of audit work, which can affect the opinion. So we've gathered all the evidence we need now. The report date is also the limit of the auditor's responsibility to search for something called subsequent events, as we'll see in chapter 24. Those are events that happen after fiscal year end, so subsequent to it, but they affect the financials. Just like if a major customer of the client declared bankruptcy in January, they haven't yet paid off their account receivable as of December 31st of the previous year under audit. What we're going to have to make sure the client does is to write that account receivable off. That's the subsequent event, that bankruptcy of the client. Yes, it affects the previous year's financial statements because having to write that account receivable off. So now, report date, very important. Okay. Any questions there on the audit report? Okay. See, we've covered that with the additional details. Well, then if we look at D here. So the clean opinion, we just saw it. It says the auditor provides reasonable assurance that there are no material departures from GAAP. Again, those terms are not absolute, giving us some wiggle room. Thus, there can be immaterial departures from GAAP or immaterial scope limitations. There will be for virtually every client. In fact, even material departures from GAAP or material scope limitations may remain undetected. As the auditor applies reasonable assurance, we don't investigate everything in his or her work, including gathering evidence on a test basis. So we don't see all possible evidence, can't afford to, wouldn't never get the audit done. So we might not see that one piece of evidence having evidence of a material misstatement in it. Well, as we will see throughout this course, if this happens, the auditor will rely on documentation in his or her audit documentation, commonly referred to as working papers. It's usually not on paper anymore, but the name sticks, to show that he or she applied due care and followed proper auditing procedures. So we document everything we do. There are plenty of audit software packages out there to help us document. In fact, in virtually every other profession today, the amount of documentation required has grown exponentially over the years. Well, that means we better document everything we think we'll need for later. If we do not document something, even though we did things right, lack of documentation, that says, ooh, we didn't do our job, because that's what people will assume, like a court of law. We just lost our case then. Again, same thing for any other profession too. Like for this building, general contractor, trust me, I had to document everything. And if they didn't, ooh, heaven forbid, they're in trouble. Now, just a few little notes about this. Well, an amount is material if it can change a financial statement rears decisions. And this is a big judgment call. But materiality is usually decided by comparing an amount against some benchmark, some base figure. For example, comparing the misstatement contained in an expense account with net income. Okay. Well, if we have $1 million misstatement of that expense for a big corporation, that might be such a tiny little drop in the bucket that it's immaterial. Tiny little percentage of overall net income in this case. For a small company, that could be very material. So materiality, it's all proportionate. Materiality is a relative concept, comparing amounts. It's not absolute, not an absolute number of dollars. Now, if something is not measurable in monetary terms, as with many scope limitations, then the judgment is even more of a judgment call. Very much so. Scope limitation, we may not know how many dollars are involved. If we don't know, well, we should remember conservatism. Would we be more likely to say that that scope limitation is material or immaterial if we're conservative, as we should be? Material. Go for worst case scenario, if in doubt. Always. Then second, some things are material due to their nature. Regardless of the dollar amount involved, I'll show you a list on page 62 in a second. We also need to add most related party transactions to this list. Related party transactions, such as major stockholders, senior management, directors, or related companies, are not arm's length, therefore possess high risk. In fact, related party transactions have been present in almost every fraud case. They don't reflect fair market value. They're not arm's length. In other words, between two adversarial parties who bargain and come up with something resembling fair market value. So, for example, in a lot of fraud cases, here's a common related party transaction. We'll find someone in senior management was given a loan by the company. However, that loan does not reflect fair market value. No interest on it. Person doesn't have to pay interest. The senior manager does not have a fixed day of repayment. What that senior manager actually got was additional compensation from the company, additional cash, and did not pay tax on it. But that's happened in lots and lots and lots of frauds. So we check out most related party transactions. Quite frankly, we make sure they're disclosed in the financials as well. Now, let me come here to page 62 in the book. Noted. So as I look here, nature of the item. So usually we're looking at the number of dollars to come up with materiality judgments. However, once again, due to the nature of certain things, they have qualitative factors, bless you, that make them material just by their nature. So here's one. Transactions which are illegal or fraudulent. We have a problem there. Yeah, transactions being illegal, fraudulent, due to their nature, even if small, somebody's doing something wrong. Readers of financials want to know. So definitely material, we check into them, and may lead to disclosure too. Number two, an item may materially affect some future period, even though it's immaterial, when only the current period is considered. For example, a lot of errors start to compound in the future. Let's say that we have a small error in a cell formula on an Excel spreadsheet right now. It might not cause too many dollars worth of misstatement. But in the future, the misstatement causes may grow bigger and bigger and bigger. So then the dollars of that misstatement do become material. Well, the best approach, the safest approach, most conservative approach is to say, let's collapse that materiality to the current year. Let's require the client to correct this. We're going to say to them it's material, fix it. Otherwise, we don't give you a clean opinion. So we have our little tool there to convince them. But that's just nipping things in the bud. Continuous improvement. Or number three, an item has a psychological effect. For example, the item changes a small loss to a small profit, or maintains a trend of increasing earnings, or allows earnings to exceed analysts' expectations. So in that case, the psychological effect on the stock market is such that we say, ooh, maybe not that many dollars are involved, maybe not otherwise material, but due to this psychological effect, let's say it really is material. Let's make the client fix it now before they get a clean opinion. Or number four, an item may be important in terms of possible consequences arising from contractual obligations. For example, the effective failure to comply with debt restriction, also known as a debt covenant, may result in a material loan being called. In other words, the client must repay it. So if the client does not maintain this bond-sinking fund to a minimum amount, they may have to repay the bondholders right away. Or maybe the interest rate goes up because they violated that debt covenant. Well, even if they violated that debt covenant by allowing the bond-sinking fund balance to drop just a little bit too low, they're still in technical violation. Maybe the few dollars involved would otherwise not be material. But in this case, because of the nature of violating that debt covenant and the bad consequences that can happen, we will say it is material. We will require the client to correct it before we give them a clean opinion. So any questions there? Any of that? As always, if you have questions, just stop me. I'm informal. Now, back here, number three, materiality does not apply for lack of independence of the auditor. For example, an auditor can not own even one share of stock in a client. When you read the AICPA's Code of Conduct for Auditing, just as background material again, you'll see, again, we can't own even one share of stock in a client. The appearance of lack of independence is such that we just can't go there. So we might say this one share of stock is immaterial in relation to the millions of shares outstanding, but never mind, the auditor still cannot own it. So either you are independent or you are not. It's binomial. Now, number four, an item may be immaterial, or it may be pervasively or highly material, or somewhere in between. So there are levels of materiality, and I bring this up because this will affect the type of audit report to issue. As we'll see on page 66 in a moment. We'll remember that a clean opinion can always be issued for an immaterial departure from GAAP or an immaterial scope limitation. Ooh, immaterial departures. I used and, pardon me, that should be singular. There we go. That should be singular too. Okay, good. However, the report must be modified if materiality is pervasive or somewhere in between. Right? Let me just write that up here on the board. And let me stop my share for those of you online for a moment. All right. So these levels of materiality. Portion of my board space there. Okay. So these levels of materiality. Well, I wish they had step stool here because I don't have a whole lot of usable board space. So again, we have the worst case scenario. We have a lot of dollars in estates. And that means highly material. Worst case scenario. So material that the effects of this misstatement will pervade the financials. They're all messed up. We're going to get the worst case scenario audit report there, so we'll see. Then, if it's smaller, we could say it's just material. Sometimes we just kind of use the word in between material. And then, if it's really small, doesn't mean anything. Not going to chase it down, not worth it. It is immaterial. Oh, it's giving us the mirror image here. There we go. All right. Okay. So I flip that around. Kind of difficult to read a mirror image. I thought something was strange as I was trying to portion my board space there. So these levels of materiality, and I realized in this room that it's really, really wide. So it's hard to see things on the board if you're on the far side of the room. Mine right. At least you can see it here on screen. And those who design these rooms don't teach. Well, we're going to consider these levels of materiality as we talk about the types of audit reports that we can issue for each one. So, first type of audit report that I'm going to be taking a look at, I'm going to sneeze, maybe not. Hey, when it feels that way. Okay. So the first type of audit report that we're going to be taking a look at will be a departure from GAAP. Okay, including a dollar amount in the statement of financials, or including disclosure that's not adequate, or including when a necessary financial statement is missing. All right. Then we'll look at a scope limitation. And then we'll look at lack of independence. I really need to bring in something from home. Little ladder would be nice in these rooms. So we'll be thinking about the types of reports that we can give. Now, lack of independence is going to be a special case. We're going to, well, let me not get at that yet. Well, let me concentrate first on a departure from GAAP. If we have an immaterial departure from GAAP, like a little dollar amount of statement in financials, that's immaterial. It doesn't matter. We can give a clean opinion in that case. So, an unmodified audit report or unqualified. Terms all mean the same. By the way, for scope limitation, same thing. We don't care about that little amount of dollars. We'll give an unqualified audit report there too. Now, if we go up in dollar amounts for this misstatement, we may bump up in the auditor's opinion. Materiality is also just the auditor's judgment. In the end, well, we may come up to this in-between materiality phase as that little misstatement grows larger. In this case, for both a departure from GAAP and a scope limitation, we will see that we will give a qualified audit report. We qualify that report. That qualification states something is wrong. And students often think that's a good thing. that company's qualified to be in business, so the auditor is qualified to do the work. But no, qualified in this case is not a good thing. So we'll see how in the audit report we bring out what was wrong. Now, let's say that misstatement grows larger and larger and larger still. So big that it's now highly material. It runs or pervades the financials. Well, if it's departure from GAAP, excuse me, we're going to get what is called an adverse audit opinion. And it's really bad. It says that, in our opinion, we believe this client's financial statements do not conform to GAAP. I've seen very, very, very few of those. Usually it's for a client who is going down the tube thing. Going to go out of business. You know, they've got a lot of problems. Then, for a scope limitation, the type of audit report, audit opinion we will give is called a disclaimer. It's bad too. It says because we cannot examine the audit evidence we felt we needed, we've got this highly material scope limitation, and we cannot give an audit opinion. In fact, if this is a publicly traded company, for both these, if the SEC sees it, how displeased do you think they will be? Very. Do you think they're warm and fuzzy people? No, definitely not. Much worse than the IRS. The SEC is probably going to suspend trading of that company's securities. Normally, the SEC will give them so long, like 90 days, to fix things. Fix things, get another audit done. And get something better than this disclaimer of opinion or adverse opinion. Otherwise, more consequences follow. Then, lack of independence. This auditor shouldn't have been there. But the auditor is not independent with respect to the client. In that case, we're going to give a really, really short disclaimer of opinion, and we will see it. No matter what the independence level is, there's a special disclaimer that we will see. Again, we shouldn't have been there. That's poor quality control on our part. We didn't check out this client as we should have. Just kind of wanted to get that set up here.
Wait, I'm sorry. I have a question.
Of course.
Okay, so just so like I understand, so when we give the disclaimer for the highly invasive material scope limitation, we're just saying we can't give an opinion because we think the data is that bad, or is it?
We don't know if it's that bad.
So we can't determine anything about the data. Okay.
Right. A disclaimer essentially signals that because of this scope limitation, we couldn't examine all the evidence coming in. We don't know what's going on. So a disclaimer is really, a scope limitation is really lack of knowledge. Whereas in a departure from GAAP, we know how many dollars are involved. But usually in scope limitation, we don't. So things are much more up in the air.
Okay, so then from the departure from gap, so to have an address report, it's like, we know how bad it is. But okay,
Disclaimer, no, we usually don't.
okay, and then so for qualified and unqualified, I know you mentioned it doesn't necessarily mean like, it's not good to be qualified, but
Right.
qualified, I don't quite understand what qualified would mean in this scenario.
Qualifying in this scenario means that there is a qualification or limitation that we have in the audit reports. So in this case, qualified, in a sense, is the antonym of qualified, as in a person is qualified to do the jobs. Absolutely.
Okay,
And that's just a quirk of English. Trying to explain that in China with like 300 students, and most don't understand much spoken English. Oh, that's a challenge.
Professor, did you go over lack of independence? I might not have heard you on that last part if you went over it.
Lack of independence. For example, we discover we own stock in a client. We should have known that before we accepted the client. So I'll talk about lack of independence after a while. More to come. All right. So number 4, got these levels of independence. Again, we remember that a clean opinion or this unqualified audit report can always be issued for immaterial departures from GAAP or an immaterial scope limitation. However, the report must be modified if materiality is pervasive or somewhere in between. And sure enough, we've got that up on the board too. All right. Let's think about something here. NA. Well, we always give the client a chance to correct before we modify our audit report. Now, if the client corrects everything, good. Then the financials are fairly stated and no material departure from GAAP or material scope limitation exists, at least of which the auditor is aware. We can then issue a clean opinion. That's why almost all audit reports are unqualified. So that might have been a big cleanup act, and that probably had a lot to cost the audit too. But if the client diligently fixes everything, great for them. They can get a clean opinion. Another little note in B, except for lack of independence, each of these departures will require the addition of the basis for the qualified opinion or disclaimer opinion or adverse opinion, which precedes or goes before the opinion section, since the opinion is modified. We'll call this an explanatory paragraph. Each of these reports is based on the standard unqualified audit report, so we'll concentrate on what is modified. So here in C, let me first talk about this scope limitation. Well, a scope limitation may result either from additions, such as when source documents have been destroyed in a fire. Okay, client couldn't help it. But sometimes conditions are such, like that fire, that, well, we have a big lack of evidence. Or scope limitation could result from the client, such as the manager refuses to allow the auditor to examine some needed evidence. Oh, that's bad. By the way, note the former is the more common scope limitation. Client won't let us examine some evidence. Well, ooh, that sounds like that client has something to hide. And that's not a very good client. It sounds like the auditor is going to be really quick to say, ooh, that's highly or pervasively material. I'm going to give you a disclaimer. Again, lack of knowledge. We just don't know what's going on with that. Maybe shady client there. Well, scope limitation will cause the auditor, again, to issue either a disclaimer of opinion, if it's highly or pervasively material, that is, or a qualified opinion if it's somewhere in between, in terms of materiality. It's often hard to decide upon materiality for scope limitations and for departures from GAAP, and that's because we don't necessarily know how many dollars are involved, since we could not conduct all the audit procedures we felt we needed. Thus, we may play it safer and more quickly decide the situation is highly material with scope limitation. In that case, we issue the disclaimer. But again, if in doubt, go for the conservative side of judgment. Play it safe. We can also note that we'll be especially quick to decide that a client-imposed scope limitation is highly material. In fact, the auditor may instead withdraw at this point, especially if he or she appealed to higher levels of management and did not obtain a satisfactory resolution. So everybody said, no, you can't examine the evidence. Bad. We'll see examples of reports for scope limitations on page 64 in just a moment. Let me look at the first two little notes here first. First, in both reports, the section of the basis for the qualified or disclaimer of opinion precedes the opinion section. I say that because the CPA exam often tests the placement of that and people forget it. But we describe what's wrong in this explanatory paragraph. We must do so before the opinion paragraph because the opinion paragraph will be modified. So the reader needs to know what's wrong before they get the opinion paragraph. That's why. I will show you. And in the qualified report, which we'll look at first, the last paragraph of the auditor's responsibility section is changed to reference the qualified opinion. The opinion is qualified with the phrase except, and the rest is the same as in the standard unqualified audit report. Good, we'll just concentrate on modifications. Won't be bad. Let me come back to the book. And actually, for those of you online, let me share my screen again. There. In the book, let me go to page 60. Here we go. Qualified report to a scope restriction. Same thing as scope limitation. AICP auditing standards, not PCAOB. So we know we're dealing with privately held clients. So figure 3.8. This qualified report, scope limitation, in between materiality. So, first part of it's still the same. Independent auditor's report, that's the same. And then same introductory paragraph, management's responsibility paragraph. And first two auditors' responsibility paragraphs is in the standard unqualified audit report. Good. Now, this next real little paragraph is changed slightly. We believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our, we add one term, qualified audit report. Now, I said we've got to explain what is wrong. So, we will have a paragraph stating the basis for the qualified opinion, or again often referred to as explanatory paragraph. Let's see what's wrong. We've got here that Laughlin Corporation's investment in XYZ Company, a foreign affiliate acquired during the year and accounted for under the equity method, is carried at $2.4 million on the balance sheet as of December 31st. Laughlin's share of XYZ Company's net income of $365,000 is included in Laughlin Corporation's net income for the year then ended. We were unable to obtain sufficient appropriate evidence, scope limitation, about the carrying amount of Laughlin Corporation's investment in XYZ Company as of December 31st. Laughlin's share of XYZ Company's net income for the year then ended because we were denied access to the financial information, management, and the auditors of XYZ Company. So it had different auditors. Not good. Consequently, we were unable to determine whether any adjustments to those amounts were necessary. So this, in fact, is a client-imposed scope limitation. Very bad. Now, this auditor, and it's the auditor judgment as far as which type of audit report to issue, decided to issue a qualified opinion. Okay. Next example, he won't. This auditor said, okay, I'll give a qualified opinion. We're going to modify that opinion paragraph a little bit. So in our opinion, except for the effects of the matter describing the basis for qualified opinion paragraph, the financial statements referred to above present fairly in all material respects, etc. Then the rest of the paragraph is the same as always. But except for this one problem. And again, the explanatory paragraph appeared before the opinion paragraph. That way in the opinion paragraph, when we said something's wrong, the rear knew. So any questions there on the qualified audit reports? Okay. Well, you know, a lot of auditors would have played that safer. They, excuse me, would have said, that since the client imposed this, oh, that's bad. They shouldn't have done that to us. They may have something to hide. So a lot of auditors would have said, let's go for worst case scenario. Let's go to the conservative side, play it very safely, and give this client a disclaimer opinion. Sure enough, in the next report, which is in figure 3.9, we'll see it. Let me come back to my chapter outline first. So, number 3. In the disclaimer opinion, we'll see it in a second, the section of the auditor's responsibility is changed in wording and is shortened by omitting the last 2 paragraphs, and that's because an effective audit could not be conducted. The introductory paragraphs modified to say we were engaged to audit, not we audited, because we didn't conduct an effective audit. And the opinion section is actually a disclaimer opinion. It says we can't give one. Bad. Let's see that here. And coming back to the book. Excuse me. I'm going to go over the next page. Oops, actually, I shouldn't. Let me go back, page 64, pardon me. So figure 3.9, disclaimer opinion due to scope restriction. All right, so this auditor's now decided, client, we don't trust you. You would not allow us to examine some evidence we thought we needed. So as a result, we're going to be very conservative, play it safe, and we're going to issue a disclaimer opinion. We can't give one. So let's look here. Still the independent auditor's report. In the first paragraph, we don't say we audited, we were engaged to audit. And the remainder is the same as in the standard unqualified audit report. By the way, we have the same management's responsibility paragraphs in the standard unqualified audit report. They're still responsible for doing the same things, and that's why. Then auditor's responsibility, this is shortened a great deal. Because we couldn't do a lot of stuff we normally do in an audit. So our responsibility is to express an opinion on these financial statements based on conducting the audit in accordance with auditing standards generally accepted in the United States of America. Because the matter described and the basis for disclaimer of opinion paragraph or explanatory paragraph, however, we were not able to obtain sufficient appropriate evidence to provide a basis for an audit opinion. So now we have that basis for disclaimer of opinion paragraph, explanatory paragraph, same wording that we had in the previous audit report. So now the reader knows what's wrong. By the time they get down this final paragraph, we don't really say audit opinion paragraph. There's no opinion. It's a disclaimer of opinion. So the reader knows what's wrong by the time they get down to this really wicked disclaimer of opinion paragraph at the end. Sounds bad. Because of the significance of the matter described in the basis for disclaimer of opinion paragraph, we have not been able to obtain sufficient appropriate evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financials. Well, financial statement readers sure will not be pleased. Questions here on this disclaimer? Right? Took care of that.
Yeah.
Yes.
Well, but if your letter have like headers like that, or is it just, that's just.
They,
If they like disclaimer of opinion at the bottom like that.
they may. It depends on the audit firm. It's actually their choice. But the book decided to put them in just to highlight it. Yeah. So that's optional. Anything else so far? Right. So, scope limitation. We don't necessarily know how many dollars are involved, so lack of knowledge. Again, departure from GAAP, we know how many dollars are involved. We have knowledge. But, well, if only a few dollars are involved, or actually sometimes more than a few, immaterial departure from GAAP will have an unqualified audit report. But if the number of dollars grows larger, we bump up into this in-between materiality phase, we'll have a qualified audit report. If the number of dollars grows larger still, we'll bump up into the highly or pervasively material phase, and we'll have an adverse audit opinion. Bless you. You bet. So let me show you that. So here in D, back of the notes. Excuse me. A departure from GAAP will cause the auditor to issue either an adverse opinion if it's highly or pervasively material, or a qualified report if it's somewhere in between. See examples on page 65 in a second. Bless you. Let me look at the first three notes here first, though. In the qualified report, only the audit opinion section is qualified. Again, the term except is used. So except for this one problem. The auditor's responsibility section is not qualified or changed in any way as an effective audit occurred. Neither is the introductory paragraph nor the management's responsibility section modified. And second, in the adverse opinion, the opinion section states the auditor believes that the financial statements are not fairly stated in accordance with GAAP. And number three, in both reports, a section for the basis of the qualified or adverse opinion is added. It precedes the opinion section. So the explanatory paragraph once again comes before the opinion paragraph. This way the reader knows what's wrong by the time they get down to that opinion paragraph. So let me show you that. By the way, tonight, what we'll do, we'll get through this down to Roman numeral 3, then there's not that much material left. And I actually have a recording, a video on that, which I will find on my YouTube channel, and I will send you the link to that. So not that much left to go, but the video, it's not difficult information. You'll do just fine. Okay. So let me come over here in the book to page 65. Figure 310. So this qualified report for departure from GAAP is figure 310. So we see same introductory, management's responsibility. An auditor's responsibility paragraphs is in the standard unqualified audit report. Only the last sentence of the auditor's responsibility section would be modified as shown next. So we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our qualified audit opinion. Same thing as for the scope limitation. Then basis for qualified opinion, this explanatory paragraph. Here's what's wrong. Excuse me. The company is excluded from property and debt. In the accompanying balance sheet, certain lease obligations that, in our opinion, should be capitalized to conform with accounting principles generally accepted in the United States of America. If these lease obligations were capitalized, property would be increased by $4.6 million, long-term debt by $4.2 million, and retained earnings by $400,000 as of December 31st, A net income and EPS would be increased by 400,000 and $1.75 respectively for the year then ended. Well, you can bet this auditor offered the client a chance to fix it before they resorted to this qualified report. But the client didn't for whatever reason. I don't know why they didn't. This nice increase here in excuse me, in assets and property, 4.6 million. Okay, long-term debt went up, but still, that's a difference of 400,000. So retained earnings would have gone up, income and EPS would have gone up. I don't know why the client didn't make a change. So not only is this a very stubborn client, but it is an extremely dumb client too. These were good changes to make. Oh, so anyway, this client steadfastly refused to correct these things. Okay, we're going to give them a qualified opinion. So that opinion paragraph is next, and we know what's wrong. So in our opinion, except for the effects of the matter described in the basis for qualified opinion paragraph just above, financial statements referred to above present fairly, blah, blah, blah. The rest is the same. Again, just like in the qualified opinion for the scope limitation. All right. Questions on that? All right. Now, let's say that the auditor decided, that's the auditor's judgment, that this misstatement really is highly or pervasively material. Well, in that case, we're going to issue this adverse opinion in figure 311. So adverse opinion due to non-GAAP departure from GAAP. So independent auditor's report. We see the same introductory, management's responsibility, and auditor's responsibility paragraphs. Excuse me. It's in the standard unqualified report. Only the last sentence of the auditor's responsibility paragraph would be modified as shown next. So just modified a little bit. We believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our adverse, we have that term, audit opinion. Then basis for adverse opinion. Same wording as in 310, what we just saw. But again, in this auditor's judgment, this auditor decided to play it really conservatively. So they gave this worst case adverse opinion. It's bad. In our opinion, because of the significance of the matter described in the basis for adverse opinion paragraph, the financial statements referred to above do not present fairly. The financial position of Ajax Company as of December 31st, or the results of its operations and its cash flows for the year then ended. Really, really, really bad. Nobody's going to be pleased with it. Questions on it? Okay. Back here in the notes. Number 4, just to let you know, a qualified opinion is also issued if there's an adequate disclosure. Let's hope that never happens in practice. Again, dumb client, stubborn client. They should have added that disclosure if the auditor said so. And the auditor is just going to bring it out in the explanatory paragraph of the audit report. Let's hope we never see that. Or if not all the required financials are present, which is called an incomplete presentation. An adverse opinion is really not applicable to these special departures from GAAP, although it could be used maybe in rare cases with an adequate disclosure, but probably not. Also, the statement of cash flows omitted. The auditor would not mention cash flows in the audit report except qualified. Now, number 5, sometimes an auditor can agree with the departure from GAAP. It could be, for example, with a client who uses IFRS, or a privately held client that uses the cash basis or the income tax basis. See this in chapter 25 a long time from now. Just to let you know, if the auditor agrees with the departure from GAAP due to special circumstances, he or she may issue a claim opinion under Rule 203 of the EICPA's Code of Professional Conduct, but must add basis of accounting section or explanatory paragraph after the opinion section. It would just talk about, for example, the cash basis in that paragraph. And the opinion section will be unqualified, but will reference the basis of accounting used. Again, it's in chapter 25, but if you want to look at an example, you don't have to yet. There it is. Let's skip number 6. And last thing tonight is E. Let's talk about this lack of independence. Well, if the auditor is not independent, special type of disclaimer of opinion which must be issued. We'll see it on page 66 in a second. You should not see this in practice. Let's hope not, as the auditor would not have accepted that client, or would withdraw as soon as they saw they were independent. Again, remember the materiality is not an issue with independence. Either you're independent or you're not. Own that one share of stock, you're not independent. So let me flip over here to page 66. We'll see this really, really short audit report. Disclaimer due to lack of independence. Well, note there's not even a report title here. This is all it says. We are not independent with respect to HomeDecors.com Inc. And the accompanying balance sheet as of December 31st and related statements of income, retained earnings, and cash flows for the year that ended were not audited by us. Accordingly, we do not express an opinion on them. That's a disclaimer of opinion. We don't give one. And this is really bad because it shows the auditor lacked proper quality control. Any questions? Again, there's a little bit of the chapter left. I will send you a link to a video on it. You'll do just fine on it. It's not difficult. All right. Again, I know chapter 3 has a lot of material in it. The most material out of any chapter here in the course. But hey, what can we say? Not everybody can get through auditing. So that's why we're going to be paid the big bucks. They're not. All right. Well, have a good one, and I will see you back next week. Again, look for an email from me within the next couple of days. If you don't get one sometime over the weekend, email me because it is some problem with Canvas. It would happen to me or to Celia Jones. A lot of things happen to her too. All right. Take care. Thanks. You too. Bye-bye.
Thank you, Professor. Good night.
Online, okay. Like our conference championship is that day, so could I be able to like reschedule it and take it at a different time?
Yeah, you'll be able to take it whenever you would like, actually, and that's good. So this way you don't have to worry.
Okay, so you don't need an excuse there or anything. Okay.
Okay.
Thank you. Have a
You
good night.
betcha. Thanks. You too. All right.